What if you could trade a $50,000 account and keep up to 100% of the profits without putting $50,000 at risk? That's not a sales pitch. That's the deal prop firms are offering right now. And if you know how to play it, it's one of the most asymmetric opportunities in trading. Here's how it works. You pay a fee. In return, you get access to a funded challenge, a simulated account with a profit target you need to hit and a drawdown limit you can't breach. Pass it, and you get a simulated funded account where you keep 80%, 90%, sometimes 100% of everything you make. The only money you ever put at risk is the cost of entry. Not your savings, not your capital, just the fee. Now, there are rules, and some of them are designed in a way that catches traders off guard. Not because the firm is trying to scam you, but because nobody explains the math underneath. In this video, I'm going to show you exactly how these rules work, which ones are dangerous, and the specific techniques to stay on the right side of all of them. By the end, you'll know how to pass a challenge, protect a funded account, and actually get paid. Let's get into it. Here's the first thing most traders get completely wrong. Trading a prop firm account is not the same as trading your personal account. You're not supposed to care about any single account. You're not supposed to obsess over whether you pass this specific challenge, because if you're thinking about one account, you've already lost. The real game is about optimizing your pass rate over the next 10, 15, 20 accounts. Think of it like running a portfolio business. Challenge fees are your expenses. Payouts are your revenue. The math just needs to make sense across the whole portfolio, not on any single position. Let me walk you through what the math actually looks like. Say you take 10 evaluations on a 50K one-step Nitro account. The challenge fee is $149. You pass 6 of them, a 60% pass rate. On those 6 funded accounts, half of them deliver a payout. Your average payout is $1,500, a conservative 3% on the funded account, which you withdraw on demand. That's the reason I chose FTM over other prop firms. You request it when you want it. No waiting, no cycles, just your money when you've earned it. 3 successful payouts brings in $4,500 in gross revenue. FTM gives you 90% of profits, so you keep $4,050. Subtract the $1,490 you spent on challenge fees, and you're left with $2,560 in net profit. The ROI on that $149 challenge fee? Over 170%. That's the number you're optimizing for. Not the ROI on the funded account, the ROI on the fee. Now here's where almost every trader sabotages themselves. They build a strategy with a 40% win rate and a 2 risk reward. On paper, beautiful. Profitable on a personal account. But plug that same system into a prop firm challenge, $149 evaluation fee, 10% profit target, 6% max drawdown, 50K account, and the pass rate barely scrapes 75% with 1% risk. The strategy is profitable, but profitable doesn't mean passable. Watch what happens if you actually want a 90% pass rate with that same system. You'd have to drop your risk all the way down to 0.5%, and it would take you around 90 trades just to clear the profit target. That's potentially 3 months of trading just to get one funded account. Slow, painful, exhausting. Now, flip the strategy. Run a 70% win rate with a modest 1.2 risk reward. Still profitable, but a completely different animal for prop firms. At 1% risk, you're sitting at basically 100% pass rate. Bump it to 1.5% and you're still at around 99%. You can crank it all the way up to 3% risk and still stay above 90%. And the kicker? It only takes about 6 trades to pass. 6 compared to 90. This is exactly why high risk reward systems quietly destroy prop firm traders. Lower win rate means longer losing streaks, deeper drawdowns, more emotional damage, more blown challenges. You're not trying to trade your way to glory on a single account. You're trying to cycle through evaluations as cleanly as possible. Higher win rate plus tighter risk reward equals more trades, faster passes, and a system that compounds across an entire portfolio of accounts. And small 1-to-1 setups are far easier to find than 3-to-1 swing trades. More setups, more trades, more frequency. So you've optimized your strategy, you've passed the challenge, you've got a funded account sitting at a few thousand in profit. Now comes the moment where most traders torch everything they just built. You've got 3K, maybe 4K of profit on the account, and the temptation hits. The leaderboard payouts are sitting at 20K, 30K. Maybe if I push just a little harder, maybe one more trade, maybe I size up, and then one loss leads to another, and another, and now you're chasing back the profits you should have already locked in, and the account is gone. Here's the rule: lock in the payout. The moment you have a withdrawable amount sitting on that account, you take it, even if it's $1,000, even if it's $2,000. Whatever the minimum is, you take it the second you can. And here's what almost nobody tells you. The structure of how prop firm payouts work means your first payout is structurally the largest one you can extract. The way the caps and payout windows are designed, the first cash out is the maximum withdrawal point for that account. You don't get a do-over. You don't get to skip it for something bigger later. That's how the math works. Combine that with the 5% statistic, the fact that most accounts won't deliver more than 1 or 2 payouts before they're gone, and the conclusion writes itself. Take the first one. Take it fast, because waiting for a bigger one means you're betting on a 5% event while sitting on a 100% certainty. That's not trading, that's gambling with your own profits. Once you've locked in a few payouts and you've got cash in your bank account, the next mindset shift kicks in. Making more money from prop firms has nothing to do with becoming a better trader. Nothing. Stop tweaking your strategy. Stop hunting for the next edge. The thing that's working is the thing that's working. Leave it alone. Because the truth is this: making more money in trading doesn't come from being more profitable. It comes from having more capital to trade with.
I gotta do it, man.
Think about it. An average trader running a 200K account will out-earn a slightly better trader on a 20K account every single time. Both might take the exact same trade, both might pull a 1% win, but for the 20K trader, that's $200. For the 200K trader, that's $2,000. Same skill, same setup, 10 times the result. But here's the question nobody actually answers. When a payout finally hits your bank account, what do you do with it? Because most traders either spend it all and have nothing left to reinvest, or they dump every dollar back into new challenges and feel like they never see the money. Neither approach builds a real business. The rule that actually compounds is simple. Every time a payout lands, you split it in 3. First, tax money goes aside, non-negotiable. Then you take the remainder and you split that down the middle. 50% for you, 50% for scaling. Let's do the math. $50,000 account, one payout of $1,500. Set aside 30% for taxes, you're left with $1,050 net. Split that 50-50. $525 goes into your personal life. That's groceries, that's the meal out, that's the thing you actually wanted to buy. The other $525 goes straight into funding new challenges. And $525 covers 3 or 4 50K evaluation fees at FTM. Just like that, you've tripled or quadrupled your account exposure on the back of one payout. That's the snowball. That's how the asset base grows. But how do you actually trade when you've got 5, 6, 7 funded accounts running simultaneously? There are 2 ways to handle this, and most traders pick the wrong one. Option 1 is the trade copier. You take a trade on your master account. It mirrors across every slave account at the same time. Think of this as pure leverage amplification. One winning trade pays out across all your accounts. But here's the catch: one bad week wipes them all out simultaneously. It's aggressive, it's high reward, but it's also high risk. Not where you want to start. Option 2 is account rotation. You trade one account until you hit a payout, then you switch to the next one. Hit payout, switch again. If you have a bad stretch, you might lose one account, but you've still got 4 or 5 others sitting untouched, ready to go. This is the sustainable path. This is what builds real income from prop firms, especially early on. And there's a hidden benefit. Account rotation fixes almost every psychological issue you have as a trader. Lose a trade on one account, you've got 4 others waiting. the emotional weight just disappears. You stop tilting, you stop revenge trading, you stop forcing setups because one account suddenly feels like life or death. As you grow, you can hybridize. Rotate batches of 2 or 3 accounts at a time, using a trade copier within each batch. Now, let's talk about the rules. There are rules you can see coming. Drawdown limits, profit targets, minimum trading days. You know where the line is. Then there are rules where the line moves, where a day that was perfectly legal when it happened can become a violation 2 weeks later. Those are the ones that matter. Those are the ones we're breaking down right now. Starting with the most common one, the one almost nobody actually understands, the consistency rule. Your best single trading day cannot represent more than a certain percentage of your total cumulative profit. On a one-step Nitro funded account, that cap is 45%. On Instant Funding Standard, it drops all the way down to 15%. The exact number depends on your account type. Always check your FAQ, but the mechanic is the same everywhere. So if you've made $3,400 in total and your best day was $1,200, that's 35%. You're fine. But what happens next is where most traders get caught. You open the next session. You have a bad day. You lose $900. Your total profit drops from $3,400 to $2,500. Now that same best day, the $1,200 from last Tuesday, is no longer 35% of your total. It's 48%. And you just triggered a violation on a day that was perfectly legal when it happened. That's the trap. The denominator moves. Every losing day makes your past look worse. So how do you protect yourself? One question. How low can my total profit drop before that best day becomes a problem? Here's the math. Best day divided by your threshold. That's it. $1,200 divided by 0.45 equals $2,667. That number is your floor, the minimum total profit you need to keep that day clean. You're sitting at $3,400 right now. Subtract $2,667. You can afford to lose $733 before last Tuesday becomes a violation. Now flip it. Same logic works for setting your take profit. Before you enter any trade, you know exactly how much total upside you can capture today without breaching the consistency cap on the other side, going too high on today's profit relative to your total. You set your TP at that number. You don't touch it. You let price do the work. This turns the consistency rule from a threat into a framework. You know your ceiling going in. You know your floor. You trade inside that corridor every single session. So what happens if you breach the consistency rule? Do you lose the account? No, you don't. The account stays open, but you can't request a payout until you're back inside the threshold. You have to keep trading until your best day drops below 45% of your total profit. Here's what that looks like in practice. You've made $2,500 in total. Your best day was $1,200. That's 48%. You're in violation. To get back inside the 45% threshold, you need your total profit to reach at least $2,667. That's $1,200 divided by 0.45. You're currently at $2,500. You need $167 more in profit before you can touch the payout button. Now a harder scenario. Same best day, $1,200, but you've had a rough stretch and your total profit has dropped to $2,000. Now that best day is 60% of your total. To get back to 45%, you need your total to reach $2,667. You are $667 short. And here's the brutal part. Every losing day while you're in violation makes the hole deeper. You lose $300 trying to recover, now your total is $1,700. The best day is 70%, and you need $967 in profit just to get back to the threshold. This is why the floor calculation matters so much. You set your stop loss before you enter the trade, not after the violation has already happened. Now, if all this feels like too much to manage, there's another option. FTM has a program with zero consistency rule, none, the two-step plus. On a $50K account, it costs about $110 more than the one-step Nitro. The trade-off is 2 phases to pass instead of 1. Phase 1, you hit an 8% profit target. Phase 2, 5%. No consistency rule in either phase, and no consistency rule on the funded account either, ever. If your trading style produces occasional big days, high risk-reward setups, news plays, breakout trades, and the consistency math feels like a constraint you don't want to manage, the two-step plus removes that variable entirely. There's one more rule worth understanding before you choose your program, and unlike the consistency rule, this is not manageable with math. It's called the floating loss limit, and it's the only rule in prop trading that can fire while you're doing everything right. Here's how it works. Your open equity, the unrealized profit and loss on your live positions, cannot drop below a certain threshold at any point. On the two-step plus funded account, that threshold is 1.5% of your balance. On a 50K account, that's $750. Not your daily loss, not your realized P&L, your floating equity, in real time, while the trade is still open. So let's say you enter a trade. Price pulls back $800 against you before reversing. Your stop loss is at $900, well within the daily drawdown limit. But for a few seconds, your floating loss hit $800. That's above the 1.5% threshold. Violation triggered, even if the trade recovers and closes in profit. A news spike, a spread widening at market open, a gap. Any of these can push your floating equity past the limit for a fraction of a second, and the damage is done. Every other rule in this video is something you can calculate, plan for, and control. The floating loss limit is not. That's why, when choosing a program, the clearest choice is one without it. The one-step Nitro has no floating loss limit, neither does the two-step plus, and that's not something you can take for granted. Most prop firms apply a floating loss limit across all their programs. FTM is one of the few that gives you a real choice. The last rule worth understanding is drawdown, and there are two versions, and they are not the same thing. The first is trailing drawdown. This is the dangerous one. Your maximum loss limit doesn't stay fixed. It moves up with you as your account grows. So let's say you start at $50,000 with a $2,000 trailing drawdown. Your floor is $48,000. You trade well. You hit $52,000. Now your floor has moved up to $50,000. You hit $55,000. Floor moves to $53,000. The better you trade, the tighter the rope gets. One bad session after a good run, and you're closer to the limit than when you started. The second is balance-based drawdown. This one stays fixed. You start at $50,000 with a $3,000 drawdown. Your floor is $47,000, and it stays there, forever, no matter how well you trade. A great week doesn't shrink your buffer. The room you have on day 1 is the room you have on day 100. Most prop firms use trailing drawdown. It's cleaner for them. The better you perform, the less risk they carry. FTM uses balance-based drawdowns across its programs. Your floor doesn't move, which means your risk management stays consistent, your position sizing stays consistent, and a strong week doesn't quietly make the next week more dangerous. If you want to try FTM, the link's in the description. I get a commission if you sign up through it. That's how I keep this content free. But I want to be straight with you. I could have picked any firm and put an affiliate link on it. I chose this one because it's young, it's hungry, and it's building a strong reputation. Independent trackers score FTM at 8.63 out of 10 with 0 logged complaints as of early 2026. In a space full of firms that disappear with your money, that number is not nothing. And one more thing. I asked FTM to put something on the table for you. The funniest or most passionate, most creative comment on this video, they're going to reward it. Check the description to see exactly what's up for grabs. Thanks for watching, and see you guys next time.